So you're getting a divorce and you're wondering, how is that going to impact your ability to purchase a home? Well, in this video, we're going to talk through the concerns, questions, fears that people have expressed. I've been doing this about 25, 26 years. So in that time frame, obviously I've talked to a lot of people with a lot of these same questions. So let's hit it and cover the totality of a divorce situation and purchasing yourself a new home afterwards, or maybe even hanging on to your current home. So that first question that most people have is, what are we going to do with the home that we currently own? Now, typically speaking, one person wants to keep that home and the other person is going to move out and maybe purchase a new home, but you have options. Obviously, you both could sell that home, take the equity from that home, and each buy yourself a new home. One could stay in and one could go buy a new place. The concerns are this. Number one concern is, who's on the current mortgage and who is on the deed to that property. So when it comes to divorce situation, the cleanest situation is refinance. Let's say both spouses are on that mortgage. The person who is going to keep the home would refinance that home, and now the home would also then be deeded into just that individual's name. Now, that's the cleanest way. That means there's now a separation financially of the two parties, which I think is important because you really want to be separated financially. So let's say you're the one moving out. They make a late mortgage payment on their mortgage that you are on. That is a late mortgage payment on your credit. Generally speaking, the best, cleanest, most effective scenario is you refinance that residence. And in that refinance, oftentimes the divorced parties are actually going to take equity from that home and use that equity from that home to pay out the other spouse. When you're doing a refinance like that and you're taking money out to pay off a departing spouse, partner, even just another deed holder, the good news is that that is not considered a cash out refinance. They actually would consider that a no cash out refinance. Even though you're taking some cash out to pay the other individual, you actually get better rates on a no cash out refinance. So if you're going to sell and both of you buy something new, great. You both get pre-approved for a mortgage. If not, and one party's going to be staying in the house, cleanest, most simple way, have them refinance. That's the best way to do it. Now, it's not absolutely necessary that you do that. Some people in more amicable situations, they sit there and they go, I've got this great 2.5% interest rate on my current loan. I don't really want to get rid of that and get rates up in, whatever they are right now. As of today, we're doing this in the beginning of 2025. Rates are in the higher sixes or so. So they look and they say, I don't want to get rid of those rates that I have. And sometimes they keep it. And that actually can be done as well, which brings us actually to our next question, which is, does my divorce need to be finalized before I can purchase a new home? So the answer to that is no. The divorce does not have to be finalized in order for everybody to go their separate ways from a housing perspective. You actually can get away with just a separation agreement, which sounds somewhat intimidating, but a separation agreement is a pretty simple document. It can be drawn up by any mediator or attorney relatively quickly if the two parties are in agreement. So it's basically just dictating what is going to be happening financially. So for mortgage purposes, we want predictability. We want to know, are you paying child support or alimony? Are you receiving child support or alimony? The assets that you have, you may have a 401k with $100,000, $1 million, $10 million, doesn't matter what the number is, but is that money yours or is a part of that going over to your ex? So the separation agreement does need to spell out the separation of assets and what the intention is with the separation of assets, as well as what the intention is with any kind of child support or alimony being paid or received, or no child support or alimony at all. But that's it. The divorce does not need to be finalized. That's not the final document out there. It is a simpler way to go forward quickly to find both individuals new housing in a divorce situation. Next question I get a lot is, are there any specific programs available for divorce situation? There's no program specific, but there are guidelines within existing programs that do apply. Even some guidelines that consider the individual who is departing the marital residence as a first-time buyer again. So potentially becoming available for some first-time buyer benefits. Not every first-time home buyer program defines first-time home buyer to include somebody divorced, vacating a marital home. So don't think you can get all those programs, but you should be able to hit up your loan officer or me. I'd love to be your loan officer, and we'd be able to kind of clarify that for you and what you might be able to take advantage of there. Otherwise, there's just guidelines ultimately that come into play when it comes to a divorce situation. So the guidelines talk about, for instance, if there are joint debts. Well, if that separation agreement says that joint debt belongs to the other individual, we can actually omit that from your payment, including the mortgage. As I said before, the best easiest and cleanest way is to come off the mortgage, but in amicable situations where you're not coming off, well, in those situations, we still may be able to exclude the mortgage from your debt to income ratios or your mortgage approval numbers in essence. Now, it's not the same for every program. If you come to me and you were to ask me, well, how come I can't omit it? Well, you might not qualify for the program that you can omit it. And another program you do qualify for, you can't omit that mortgage. It gets a little bit more nuanced, but the best thing to do, again, is to talk to a mortgage professional to see what you qualify for, because what you qualify for may actually dictate which of these things I'm saying here in this video may be true or not. So I'm giving some general stuff of what can be done, but certain programs might be slightly different. So no specific programs, but listen, divorce happens all the time, and therefore there are guidelines pertaining to that. I will tell you another thing that does make it easier in divorce situations is when both parties are working with the same loan officer. Oftentimes that can just make it a smoother transaction. That individual knows the situation from both ends, and that individual, like myself, again, love to be your loan officer, that individual, like myself, should also have a wall between those two applications, right? They're not talking to your spouse about you. They're not talking about you with your spouse. There should be a wall there. Professionalism would dictate that only information shared over that wall is information they were given permission to do. But it does make it easier a lot of times. So I've had several situations where one of the spouses is buying a house, the other one's refinancing, and being able to do that simultaneous, everybody knows when everything's happening. We can time it correctly and make sure that happens efficiently for everybody. So that's just a little bit of something that I've learned through the years. Using the same person is helpful. But we also understand that in situations, in divorce, sometimes it's not always amicable, and sometimes people are uncomfortable with that. So either way, each individual does need to be with a loan officer or mortgage person that they trust, ultimately. The next question I get a lot is about child support and alimony and how that's going to impact things. So let's first talk about the person that's receiving it. Most programs do require you to have received it for a specific period of time before it can be used. Some programs are 3 months, 6 months, 12 months. Depending on the program, you may have to have received that child support or alimony for a specific amount of time before it can be used. Now, if you qualify for a home without the child support or alimony, that person receiving it, no problem. You don't have to use it to qualify, but if you need it to qualify, you may have to have received it for a certain period of time before that can be utilized. Now, if you've just gotten divorced and you were separated and had an agreement a year ago and you've been receiving it for a year and your divorce was finalized today, no problem, because you already have a history of receiving it. But that is something to consider. The other thing to consider as the receiver of child support or alimony is how that money is taxed for you. As a receiver of those funds, child support comes to you post-tax, meaning as the recipient, you do not pay taxes on it because your spouse already did. Alimony comes to you pre-tax, and your spouse does not pay taxes on it. You actually pay taxes on it. Now, of course, check with your tax professional. Make sure this is applicable to you. That's generally how it is, but I'm not a tax guy. I'm Brad, the mortgage guy. So anyway, check with them, obviously, but generally that's how it's done. Now, in mortgages, when somebody is receiving tax-free income like child support, we can what's called gross that income up, meaning we would look at that and say, well, if somebody who worked a job took home, say $1,000, they might have to make $1,200 to receive $1,000 take home. We want to say, oh, wait a second, this is tax-free. We're going to gross it up, meaning we can take and add on to that. Some programs let us add up a 15% on top of what you receive, others up to 25% of what you receive from child support. We can add to your effective income for qualification purposes. Now, on the other side, you're paying child support or alimony. Well, there's some things to think about there as well. As soon as you get divorced or have that separation agreement in place and are paying those amounts, that's going to hit you as if it's a debt. Both of those can hit you as if it's a debt. Now, it can be treated differently because of the taxes here as well. Child support, because as the payer, you pay taxes and then pay your child support. Child support is looked at like a debt, like a car loan, like a mortgage, like any other debt that's on your credit report. It's going to be looked at as a debt. Now, alimony can be looked at differently. However, with most programs, alimony can be looked at as a reduction of income. Now, this is really, really important for people who are paying alimony, especially people who who are paying large sums of alimony. Let me give you an example here that just uses some real easy numbers for us to understand, okay? Let's say you were making $10,000 per month, $120,000 a year, $10,000 per month, and you were obligated to pay $5,000 in child support. The way that calculation would work is they would say you make $10,000, you pay $5,000, your debts, just the child support, forget about your car, forget about your other mortgage, forget about anything else, credit cards, just the child support, 50% of your income is going towards your child support. So your debt ratio is now 50%. No way you're going to be able to qualify for a home after that because 50% of your income is already going to a debt. Now with alimony, it works out a little bit differently. Alimony in that same scenario, they would say, okay, instead of making $10,000, you only make $5,000 a month. So now you are a $5,000 a month earner. And in essence, your debt ratios, you don't have any debt at that point pertaining to child support or alimony at least. But now when you take on a mortgage of say $2,000, that $2,000 is 40% of your income, right? And your debt ratio on that mortgage is 40%. Now, still high. I'm using ridiculous numbers here, but you get the point. If you're paying alimony, we can actually treat it in a way that is going to benefit you more so as a buyer to where we're reducing it from your income as opposed to adding it as a debt. So a little bit of a nuance there when it comes to mortgages, but that could actually help you as the person paying child support or alimony in this case. Another question I get a bunch is how is divorce going to affect my credit? And the answer to that is it doesn't affect your credit at all. Divorce has no impact on credit whatsoever. What does impact the credit is how individuals act oftentimes during divorces. Oftentimes there's some spitefulness. People are upset. There's a lot of emotions. And unfortunately, that's usually what causes the impact to the credit. I've had people not pay the mortgage for several months, and then the courts actually forced them to sell, even though that person wanted to keep the house. They thought that they were getting back at their spouse by paying that mortgage late, and therefore the courts actually came in, and because they were doing that, said you either have to refinance or sell the house. And because they paid their mortgage late, guess what? They couldn't refinance and therefore had to sell their house. So they were getting back at their spouse, and they really hurt themselves at the same time. And this is also one of the reasons why I do say that you don't want to keep the mortgage that you're both on. When you have somebody keeping a departing residence, you really want that person to refinance and take the other individual off of the loan, because this stuff happens all the time. You might think it will never happen to you. Both of you may have paid all your bills forever and on time, perfect credit, everything. But sure enough, whether it's on purpose or not, and it's not always on purpose, by the way, either. Sometimes it's just a spouse that wasn't the one that handled the finances in the home, and now all of a sudden they're handling all the finances and they just forget a bill. And look at that. Now I've got a late on my credit. You don't want any lingering debt that's crossed over between the two of you. You really want to have that separated out. So again, credit-wise, it is not going to impact your credit unless people are paying stuff late. People are doing things that is going to cause that impact on credit. That's about the most popular questions we have. If you leave any questions in comments, I'm happy to reply to those. You can also hit me up. My information's in their bios in the video, and it's all over the place. So feel free to find me. Look up Brad.Salerno, guaranteed rate. You'll find me there online. Ask any questions you got. I'm happy to answer any questions you have. Just know getting a divorce does not mean you're not going to be able to own a house. There are absolutely ways to set you up and put you in a good spot for that. All right? Have a good one. If you have any questions, hit us up in the comments.